I know I've been in this position, and I think a lot of you have too. When you find a stock of a really great company under great economic conditions, but it's trading at a slightly higher price than you want to pay. Perhaps by a few cents, perhaps by a few bucks. The point is, you want this stock for a lower price. And yet at the same time, you fear that the stock is destined to go higher, so you fear that if you don't get in now, then you'll miss out on any possible gains. So you have two options here. One, get in now for fear of missing out on additional gains. Or two, hope for a pullback later and jump in only when the stock triggers your desired entry price. Well, there's a third way, folks. But you know what? Before we get to that, let's throw in another scenario. Now let's say your stock is tanking, but it's a long hold for you. The company's reliably profitable, you're sure it'll go up eventually, and you're thinking it's time to average down. However, you fear that it may go lower on sentiment alone, and you may miss out on a better price to average down at. Yet at the same time, you think to yourself that if you don't average down here, the stock could turn around, and you would have missed out on averaging down at a lower price. Once again, you have two options. One, average down here and hope for a turnaround, or two, average down later in the hopes that you'll get the shares even cheaper, thereby granting you a lower overall cost basis. Once again, there's a third way. A cash secured put may be the answer to both these scenarios. The problem is there are a ton of retail traders who have no clue as to the benefit of selling puts. Oh, they know they can buy calls if they expect the price to go up, or puts when they expect the price to go down, but they rarely consider selling options. They fear getting assigned, they fear the unknown when it comes to options, or they simply cannot wrap their mind around the concept of selling puts. And of course, this is what I aim to remedy today. And with that said, my name is Chris, welcome to StockTips, and I hope you enjoy the video. Alright, just as we did in our covered call video, I'm going to use the same ticker, MO Inc., ticker POWW, in our cash secured put video. Now, I want you to look at the prices here because this particular ticker has come back a long way, and I wouldn't necessarily advise at this point that you use covered calls against the 7.5 strike. Matter of fact, if you're just now starting a position in a ticker like this, I would definitely look at the covered calls for the $5 strike. As for me, I still have a lot of faith in this company. I still believe this company is destined to go higher in the future, and therefore I will continue to sell the 7.5 calls against the underlying. I won't sell the $5 calls because that would be selling calls below my cost basis, which means if assigned, I'll lose money. However, I do need to average down, so I have three options here. I can either buy shares at this price, hope for it to go lower and buy shares at a lower price, therefore lowering my cost basis even lower, or I could sell cash secured puts. I'm going to sell cash secured puts. However, for a moment, let's pretend I didn't have a position in this company and I was thinking about establishing a position in this company. One way to take a lot of risk out of establishing the position would be simply to sell the cash secured put at the $5 strike, assuming that I had no position whatsoever. So what we're looking at now is a 16 December $5 cash secured put. Now what makes this so attractive for someone who's thinking about starting a position? Well, if I'm bullish on the company, it means that I think the price is going up. And if the price is going up, I'm going to make money on any puts that I sell. However, if the price goes down, I can still make money, so as long as it expires above my break even. And I do believe by December it will expire above my break-even. And right now the share price is sitting at $4.79, meaning if I sell the $5 cash secured put, I'm already in assignment zone. So as long as it's below $5, I can be assigned those 100 shares. Now remember, a put gives the contract holder the right but not the obligation to sell you 100 shares at the strike. And because we are selling the $5 put with the share price at $4.79, the contract holder can technically assign us those shares at their leisure if they want. However, for reasons you're about to see, that really doesn't matter, at least not at $4.79. And that reason is staring you in the face right now. That premium for the 16 December $5 put is $1.50. So with a $5 strike with a premium of $1.50, the true cost to you upon assignment is $3.50. No matter where this is trading at, if you are assigned, you will pay $3.50 per share for 100 shares. Nevertheless, there is an opportunity cost to be had here, in that you're going to have to lock up $350 in case you're assigned. Your broker isn't going to pay that for you, and this is why it's called cash secured puts. You got to have enough cash in reserve to be assigned if it comes to that, and your broker is going to ensure that you have that in reserve. What this means is you have $350 sitting around that you can't do nothing with because you sold a put contract. But hey, check this out. You risked $350. In short, you locked away $350 for a chance to make $150, which amounts to roughly 42.86% of the amount of money that you locked away. However, that's max profit. You do not need the share price to expire above $5 in order to profit from this. So as long as the share price by expiration is between your break-even price and the strike, you're going to make money on this play. The only way you don't make money on this play is if you are assigned at a price below your break-even price, or the contract expires with the stock trading at a price below your break-even price. Even if it's trading below your break-even price upon expiration, you're still going to receive the stock. And if it's not too far below your break-even price, you can sell calls against the underlying or perhaps wait for that position to swing. Either way, if you are assigned, you're still going to receive the shares. You're just going to pay $3.50 for them no matter where it's trading at, so as long as it's between $0 and $5. However, if that put is above $5 by expiration, the contract expires worthless and you max out on the profit by keeping all of the premium. Okay, now let's look at the 16 December 750 strike cash secured put. In my current situation, where I am holding this stock at a price well above current trading value, I like this option. If I were to average down on shares alone, I risk losing additional money if the price continues to drop. However, if I were to sell the 7.5 December strike put and end up getting assigned, the true cost to me would be my break-even at $3.90 per share for 100 shares. Also, if the price turned around and went back up to $7.50, I would be green on my share position, and I could realize a max profit of 92% of the money I locked away. And of course, selling such a deep in the money put increases the likelihood that I will be assigned, though I don't mind that because I truly want the shares. And getting assigned at the price of $3.90 beats the hell out of paying $4.79 to average down any day of the week. Alright, here we have a fictional company called XYZ. Let's say that we really like XYZ, but we just don't like the share price it's trading at. Right now it's trading at $110 per share, but we want it for $100 per share. We've done our math, we've done our models, we've done our due diligence. We know where the value is in the stock, and we think that value is at $100 per share, but we can't get it for $100 per share because it's trading at $110. So why not sell a cash secured put? I want to buy 100 shares anyway. So let's say that's exactly what I do. I sell a $100 strike cash secure put to expire in a month. Now let's say, come expiration, the share price is above $100 per share. Well, I sold a $100 cash secured put. That contract is now worthless. I profit by $500, roughly 5.26% of the money I had locked up. However, come expiration, let's say that the price is trading below $100 per share. I get the stock that I wanted for the price that I wanted. You can't beat that, folks. At the same time, you really don't need the strike to be at the price you want. You need your break-even price to be at the price you want. After all, you think that price is a good price. That's the price you want it for. So as long as your break even is at that price, that's what you pay for the shares. In any case, that's all I have for you. There is some more nuance than I let on in this tutorial, but I think I've covered the bulk of it. Yet again, for you folks new to options, this is not an all or nothing option strategy that will blow up your account if things go south. All the money you need if the trade turns against you is deducted from your buying power by your broker. Indeed, you won't even need to worry about accidentally spending the cash from your cash secured put because your broker, in most cases, will not let you. And if you ever get tired of holding this position as the price increases, you can always buy back the put as the position develops, hopefully for a lower cost than what you sold it for. Remember that time decay is your friend here, and although in between now and expiration, the price action may look ugly, all that matters is if the stock is trading above or below your break-even point. That's if in fact you're willing to carry the position to term. Anyway, I hope you found this useful. I hope you enjoyed it. Please do not forget to hit that like button, and please join the StockTips family by subscribing as a free subscriber in the link below. Thank you for your time. Thanks for listening. God bless and safe trading.